Hi there, it's Monica, president of the Guru Intelligence Network here. I hope you're having a wonderful Monday. We're back today talking about Warren Buffett's 5M strategy and for stock investing. And we're continuing on in our section of management, which is Warren Buffett's 4th M. And today's session is about the proof being in the numbers. If you are liking these videos, please subscribe, like, and share, and keep watching them. So today we are going to look at whether the management that we looked at last week, we looked at their qualities to see if they would make good managers. And this week we're going to actually determine whether that is actually true with the numbers that they produce. So as we said last week, the reaction of weak management to weak operations is often weak accounting. And this is what we're looking at when we're analyzing a company. There's actually 3 numbers that really help us to determine whether the manager is doing a good job, and those are debt, return on equity, and return on invested capital. These numbers allow us to see how well the CEO is allocating capital and whether he's putting the company in any kind of precarious position that we don't want the company to be in. So the first one we're going to talk about is debt, and Warren Buffett says, I do not like debt. I do not like to invest in companies that have too much debt, particularly long-term debt. The long-term debt increases in interest rates can drastically affect a company's profits and make future cash flows less predictable. So if you think of yourself as a homeowner, hopefully most of you have got a home, you will have a mortgage attached to that, and that would be sort of similar to long-term debt. And we've all heard the phrase being house poor, and that's usually when you've actually bought a house that's too much money for what you can actually afford. And so this is what Warren Buffett's talking about. So how do we determine if a debt is a good number or a bad number? Well, we usually look at this ratio called debt ratio, and that's taking the company's earnings from last year and dividing it by the long-term debt number. And ideally, we want to see that number to be less than 3. Of course, we want it to be 0. The best company is one that has no debt at all, because that means there's no risk for that type of bankruptcy. So the next number is return on equity. So Warren Buffett says focus on return on equity, not earnings per share. And the reason he says this is because Wall Street tends to focus on earnings per share, but this number is a fudgeable number because it's a per share number. Earnings can actually stay the same or decrease as long as the company buys back their shares. And we've been seeing a lot of companies do this over the years. And so it really gives a false indication of how well a company is doing. So we want to look at return on equity. And the formula for that is net income over shareholders' equity. If you can get the free cash flow number, that one's even better because that actually gives you the amount of cash they have to pay come in, and that's over shareholders' equity. So for the ROE, we want to see numbers that are over 10%. We would like to see them staying the same or growing, but we don't want to see them decreasing, especially not at a huge rate, because that could indicate there's something really going wrong with the management there. And the last number we're looking at is return on capital. So Warren Buffett says the ideal business is one that earns very high returns on capital, that keeps using lots of capital at those high returns. So that becomes a compounding machine. So what he's saying is any capital that they keep putting back into the company, so that helps the company to grow, is a really great way to spend money in a company. And that's the kind of thing he's looking for. He's not looking for businesses necessarily that are taking their profits and just handing it over to their shareholders. He's looking for businesses that are wise with their money. So if they have profits and a huge debt, are they paying down their debt to make their numbers more sustainable in the future, or are they just wanting to keep the shareholders happy, and sometimes they actually borrow money to pay off their shareholders, which is something that's terrible, because that just puts them in more of a bad situation with debt. So look at those types of numbers when you're looking at the financial statements. So return on invested capital, it is calculated by taking the net operating profit after tax, or the NOPAT, over invested capital. And again, we want to see that being 10% or higher. We want to see it going up or staying the same over the course of the years. You can calculate the growth rates for the ROE and ROIC, just like we did with the MOAT calculations that we did for the 10-year, 7-year, 5-year, and 3-year. Again, we want to see 10% or better. And if we have a company that isn't so great and we haven't done these numbers and calculations and the analysis, we may have a company that might be swimming naked. So Warren Buffett is saying, only when the tide goes out do you discover who's been swimming naked. And this is one way to uncover that. So I hope you really enjoyed this session on management. Next week, we're going to go into the 5th M, which is margin of safety. And this one's my favorite because this is where you can actually take that number and go out and buy some stock and know that you're investing in a really good investment, and your risk is really low and your returns are really high. So I hope you have a really good Monday and a really good week, and we'll see you again next Monday.